Welcome back, learners, to The Deep Dive, your go-to guide for, well, getting to grips with those crucial concepts from your exam study materials.
That's right.
Last time, we really laid the groundwork, didn't we?
Wow.
Diving deep into Module 3, exploring, the foundational concepts of governance, what it actually is, and why it's just so vital for any organization.
We did. We covered the principles, the frameworks, those big ideas that really shape how companies are run.
Exactly. And today, we're building right on top of that foundation. We're taking a significant step forward into the practical application of those governance principles.
Precisely. If our last deep dive was about sort of the what of governance, then this session, focusing squarely on Module 4, is all about the how, and maybe more importantly, the why it truly matters in real-world situations.
And for the exams, of course.
And critically, for your upcoming exams, yes. We're shifting gears a bit from the purely theoretical to the actionable. So we'll be looking at how boards actually function day to day, the operational responsibilities that have a real impact on stakeholders, and that crucial link between corporate governance and audit integrity, all while trying to navigate the complexities of regulatory compliance.
Phew. Sounds like a lot.
It is, but everything we discuss, importantly, is drawn directly from your study guide, so it's tailored precisely for your success.
Great. So let's kick things off. And the study guide starts with a rather sobering observation, but an incredibly insightful one. It reminds us, quoting the former KPMG chairman David Crawford, that there ain't no new way of going broke. It's quite a striking way to begin, isn't it? Sort of sets the tone immediately. That, corporate failures aren't usually these sudden, dramatic implosions.
Yeah, not at all.
They're often the slow, maybe painful results of just ignoring the basics, the fundamentals.
And that's exactly the point the guide makes. You look at the research at Altman and Hotchkiss, others, it consistently finds that fundamental management inadequacies are almost always at the heart of these failures.
Right.
We're not just talking about isolated bad decisions here. It's often a deeper, more systemic inability to truly read the market or to understand how external pressures can completely unravel an organization's operations.
Okay.
Your study guide highlights work by Hamilton and Micklethwaite. They looked at some infamous collapses, Enron, Barings Bank, WorldCom, you remember them?
Oh, yeah.
And they identified 6 common categories of failure. What's really fascinating and relevant for us is how many of these stem directly from governance breakdowns.
Okay, so unpack those for us.
Yeah.
What are these common pitfalls that companies, keep stumbling into again and again?
All right. The first one is poor strategic decisions. This is basically when management fails to grasp the fundamental drivers of their own business. Maybe they expand into new markets they don't really understand,
Overreaching?
Exactly. Or launching products without any clear competitive advantage. Think Blockbuster just ignoring Netflix. A classic, almost textbook strategic misstep.
Painful to watch, even in hindsight.
Isn't it just? Then number 2, there's inadequate financial controls. This is, it's like a slow leak in the financial plumbing of the company. Undetected issues, maybe misreported earnings, or just a lack of proper oversight on spending. These can quietly drain a company's resources until it's just too late.
Okay, number 3.
Third is a lack of clear leadership. Without a clear vision, without someone really at the helm setting a direction, an organization can just drift aimlessly.
Yeah.
And in today's dynamic markets, that lack of purpose very quickly leads to a loss of competitive edge. You just fall behind.
Makes sense.
Fourth, and this is critically important now, is failure to innovate. Stagnation is, it's basically a death sentence in business today.
Absolutely.
Companies that don't continuously adapt, don't develop new offerings, or fail to improve their processes will inevitably, eventually, be outmaneuvered by more agile competitors.
Okay, number 5.
The 5th category covers weak organizational structures and poor risk management. This creates critical gaps in how information flows. So if the right people aren't getting the right information at the right time, or if risks aren't systematically identified, assessed, and mitigated, the company is essentially flying blind. It's vulnerable to anything the market throws at it.
Yeah, you can see how that leads to trouble.
And finally, number 6, which brings us right back to governance. Ineffective boards. Now, directors are meant to provide independent oversight. That's their job.
Right.
But sometimes they can become too financially or personally intertwined with management. Too close.
Conflicts of interest.
Exactly. And when that happens, they can shift from being independent overseers to, basically rubber stamps. and that compromises their judgment, leading directly to significant governance failures.
It's particularly striking, I thought, when the study guide emphasizes the role of cash flow here. Citing Dun & Bradstreet CEO Christine Christian, who famously said, "Poor cash flow can sink a business faster than poor sales." That really makes you pause, doesn't it? I mean, you could be selling loads, but if the money isn't actually hitting the bank account.
You're in serious trouble. Absolutely. The global financial crisis was just a stark, real-time example of this very principle.
Yeah.
So many businesses simply weren't prepared for the economic slowdown. The immense strain on cash flows led to a huge spike in bad debt claims. And you can draw a direct line from this back to governance breakdowns.
How so?
Well, if boards are chasing short-term profits through overly risky ventures, maybe, or if they're willfully blind to the warning signs flashing red, a cash flow crisis becomes almost inevitable.
Right.
Those issues we talked about earlier, excessive executive remuneration tied to short-term goals, willful blindness, poor risk management, they all directly contribute to these fundamental business problems ending in failure, which logically leads us to a really fundamental question. How do we ensure we actually have capable directors on boards in the first place? The process of appointing them and then holding them accountable is just paramount for good governance.
So what are the basics?
Well, legally, a director has to be a natural person, at least 18 years old, and crucially, not disqualified from managing a corporation. That seems pretty straightforward.
It does.
However, here's the maybe surprising insight. Unlike many executive positions, which often demand specific qualifications, a finance degree, extensive industry experience, whatever it might be, there are often no specific legal qualifications required to be a director.
Really? None at all.
Legally, often none. Now, this can lead to situations where some appointments, frankly, add very little genuine value to the board's strategic capabilities. And perhaps even more intriguingly, under certain rules, like the ASIC listing rule 14.4 in Australia, the managing director, who is typically the CEO, might actually be exempt from shareholder election.
Wow, so the CEO might not even face a vote from the owners.
Potentially, yes.
Right.
Which means their position isn't always directly scrutinized by the very people they're ultimately meant to serve. That's a really significant nuance in board dynamics to keep in mind.
That is quite a revelation, isn't it? So, okay, if shareholders are the ultimate owners, but the CEO might not face election and director qualifications aren't legally mandated, how do shareholders actually exert their power? How do they challenge board decisions or even the appointment of these directors? What real mechanisms are actually in place?
It's a fair question. Shareholders do have a few critical avenues, though they might require some coordination. For instance, any individual, or more likely, a group holding at least 5% of the voting shares, can actually demand the board call an extraordinary general meeting, or EGM.
Okay.
And here's the kicker, as the study guide points out. The company usually has to bear the expense of calling and holding that meeting.
That gives it some teeth.
It does. It's a powerful tool to force discussions on urgent matters the board might perhaps prefer to ignore. Beyond that, if a general meeting is already scheduled, shareholders holding 5% of the votes, or even just 100 members acting together, can propose resolutions to be put to that meeting.
Including removing directors.
Including motions for the removal of directors, yes. These provisions really underscore the potential for shareholder activism, even if, organizing that 5% or those 100 members can sometimes be a practical challenge. And building right on that idea of shareholder power, we absolutely have to talk about the two strikes rule. This is such a crucial mechanism specifically designed in Australia to give shareholders more influence, particularly over executive remuneration and holding boards accountable for pay decisions.
Okay, how does it work exactly?
Right. So here's the process. If a company's remuneration report, that's the report detailing executive pay, receives a vote of 25% or more against it at an annual general meeting, or AGM, that's considered the first strike.
A warning shot.
Precisely. A clear signal of significant shareholder dissatisfaction. Now, if at the very next AGM, the following year, that company's remuneration report again receives a vote of 25% or more against it, that's the second strike.
Okay, two strikes.
And when that second strike hits, it automatically triggers something called a spill vote at that same AGM.
A spill vote, what does that entail?
It's a resolution put to the shareholders to determine if all the directors, with one key exception, should be essentially removed from the board and have to stand for re-election if they wish to continue.
All directors. Wow. Who's the exception?
The managing director, usually the CEO. They are specifically excluded from this spill vote, so their position isn't automatically jeopardized by this particular mechanism. That's a key detail.
Right. So what makes this rule so powerful? You said it empowers independent shareholders.
Yes, and here's why. Key management personnel, the KMP, so directors and senior executives and their related parties, are explicitly not eligible to vote. They can't vote on the remuneration report itself, nor can they vote on the spill motion if it's triggered.
Ah, so they can't just vote to approve their own pay packets or block a spill.
Exactly. It means directors and executives can't use their own, often substantial shareholdings to just rubber stamp remuneration decisions or prevent a board spill. The decision truly rests with the independent shareholders, giving their votes a much larger proportional weight, especially in triggering those strikes.
Okay, that makes sense. So the study guide poses question 4.1, asking us to explain the significance of the shareholder vote here, noting the 25% thresholds for the strikes and then the 50% for the spill, and how eligible votes in all shareholders play a part. How should we think about that?
Well, the significance lies precisely in those escalating thresholds and the shifting voting base you mentioned. The initial 25% against vote thresholds for the strikes are significant because they signal substantial dissatisfaction without immediately forcing a change. It puts the board on notice, essentially.
Chance to respond.
Right. And the fact that it's 25% of eligible votes, meaning KMP are excluded, makes these initial strike votes genuinely representative of independent shareholder sentiment. They can't be easily dismissed. Now, if that second strike occurs, the spill resolution itself then requires a simple majority. So 50% or more of the eligible votes cast on that specific resolution.
Still excluding the KMP.
Still excluding the KMP and related parties. That's crucial. It means independent shareholders, even if they don't technically hold an absolute majority of all the company's shares, can still force a complete overhaul of the board leadership, apart from the MD, if they are sufficiently united in their dissatisfaction. It moves beyond just disclosure or expressing concern. It's a direct, powerful tool for enacting real board change based on remuneration practices. Now, if we broaden our views slightly, director disqualification is another really critical safeguard for maintaining market integrity. It's fundamentally about removing individuals from positions of influence when their past conduct clearly demonstrates a lack of commercial responsibility or basic integrity.
Okay, so what kind of conduct leads to disqualification?
Your study guide outlines several circumstances. Things like being found responsible for significant civil wrongs. Financial market misconduct is a big one. Having a history of involvement in multiple company insolvencies. Proven dishonest actions, specific corporate crimes, and also engaging in serious anti-competitive behavior.
Right. And are there different ways this happens?
Yes, there are two main types or paths to disqualification. One is automatic disqualification.
Automatic.
Yeah, so for example, if someone is declared personally bankrupt, in many jurisdictions, they are automatically disqualified from being a director for a set period while bankrupt. Similarly, convictions for certain serious criminal offenses, especially those involving breaches of corporate law or dishonesty, can trigger automatic disqualification. These are usually linked to proven criminal breaches, and the principles are fairly consistent internationally.
Okay, and the second type?
The second type is court-ordered or regulatory agency disqualification. Courts can impose disqualification, potentially for much longer periods, sometimes up to 20 years, or even more often for misconduct, involving what the legislation defines as civil wrongs that attract civil penalties. Think serious breaches of director duties.
Right.
And regulatory bodies like ASIC in Australia or similar bodies elsewhere can also disqualify directors, particularly if there's a track record of multiple insolvencies suggesting incompetence or other serious breaches of probity.
What are the underlying ethics here? Why do we do this?
The ethics are pretty clear, really. Disqualification primarily acts as a deterrent, warning others against similar misconduct. It also serves to protect the public, specifically investors and creditors, from individuals who've shown they might cause harm again. And finally, it provides reassurance to the markets and the wider community that there are tangible consequences for egregious corporate misconduct. It reinforces trust.
Okay, so let's tackle question 4.2 from the guide. From the perspective of the disqualified person, what's the effect of being disqualified? And what's the key difference between court ASIC ordered disqualification and automatic disqualification?
Right. Well, from the disqualified person's viewpoint, the effect is immediate and frankly profound. They are legally barred from managing any corporation, whether as a director or even in certain senior management roles, for the entire duration of the disqualification period.
So it effectively ends their corporate leadership career, at least for that time.
Absolutely. For that duration, yes. It significantly impacts their reputation, their future employment prospects, and their financial standing. And the social stigma attached can also be immense. It's a very serious consequence.
And the key difference between the types.
The key difference lies mainly in the trigger for the disqualification and often the potential duration. Automatic disqualification, as the name suggests, is an immediate, almost administrative consequence of specific predefined events like personal bankruptcy or a specific criminal conviction. The term is often fixed and might be shorter. It's a relatively straightforward application of the law once the triggering event occurs. Court-ordered or regulatory disqualification, on the other hand, comes after a specific legal process. A court or a regulator makes a considered judgment based on the individual's specific conduct, often involving serious civil wrongs, breaches of duty, or persistent misconduct that might not necessarily be criminal. These proceedings typically result in much longer disqualification periods, reflecting the perceived severity and perhaps the deliberate nature of the misbehavior being addressed. So while both functionally bar the person from managing companies, the pathway to disqualification and the potential length of the ban differ significantly.
That makes perfect sense.
Yeah.
So thinking about all of this, the pitfalls of corporate failure we discussed, the need for truly capable directors, the mechanisms for accountability like 2 strikes and disqualification, what does it all really mean for building genuinely strong, resilient boards? It seems to suggest quite strongly that we need to think beyond just traditional profiles, right?
Absolutely.
We're talking about the fundamental value of board diversity. And your study guide defines diversity really broadly here. It's not just gender or race, but encompasses ethnicity, sexual orientation, age, physical abilities, educational background, socioeconomic status, even differing beliefs and perspectives.
That's right. It's a very inclusive definition.
And it's not just about fairness, though, of course, anti-discrimination laws are crucial and play a role. It's actually about performance, isn't it?
It absolutely is. A genuinely diverse board inherently brings new skill sets to the table, fresh perspectives on old problems, and it tends to foster more innovation and robust debate. It challenges groupthink. Ultimately, as the evidence increasingly shows, it adds significant tangible value to the corporation, making it more resilient, more adaptable, and often more profitable in the long run. And the regulatory push for diversity has become increasingly strong over recent years. You look at the ASX Corporate Governance Council's principles and recommendations, for example, the 2019 revision. Recommendation 1.5 specifically suggests listed entities set measurable objectives for achieving gender diversity. And it mentions a target of not less than 30% of each gender on boards, in senior executive positions, and across the workforce generally.
So clear targets being suggested.
Suggested targets, yes. And this isn't just an Australian trend by any means. You see similar emphasis internationally. The UK Corporate Governance Code, for instance, also stresses the importance of establishing clear diversity policies, looking beyond just gender.
Right. Is there a consensus on the best way to achieve this? Quotas versus other approaches?
Well, that's where there's still quite a bit of global debate. Some countries, like Norway initially, then France, Spain, and others have successfully used mandatory quotas to significantly increase gender diversity on listed company boards relatively quickly.
So forcing the issue?
Essentially, yes. Setting legal requirements. The alternative approach, favored in places like the UK and Australia, is more focused on industry-led initiatives and targets. The 30% Club is a prime example. It's a global campaign run by business leaders themselves, aiming for 30% female participation on boards and in senior management through voluntary targets, advocacy, and peer pressure. It now has chapters in about 18 countries.
And how's that working in practice? You mentioned the targets, but what does the real-world data show?
Well, that's where it gets interesting and perhaps a little frustrating. While we've definitely seen progress, particularly in board representation in some countries, recent reports like the Chief Executive Women CEW Census from 2023 in Australia show that the challenge remains significant, especially in executive leadership.
Ah, okay. Below board level.
Exactly. That report found that despite all the focus, women still hold only about 27% of executive leadership roles in the ASX 300. And perhaps even more concerning, the number of companies with no women at all in their executive leadership teams had actually increased slightly since 2021.
Really? That's surprising and disappointing.
It is. It really highlights that while setting policies and targets at the board level is a necessary first step, the actual implementation, changing recruitment practices, addressing cultural barriers, and building the pipeline takes sustained effort and commitment throughout the organization. It reinforces that good diversity policies, genuinely embedded and driven by both boards and management, are absolutely critical for strong corporate governance. It's ultimately about ensuring the best talent from the widest possible pool is leading these companies. Now, shifting focus slightly, let's talk about executive remuneration. What's truly fascinating here, and something that gets a lot of public attention, is how executive pay has become so deeply intertwined with both public perception and, critically, corporate risk-taking behavior.
Yeah, you certainly hear a lot about CEO salaries in the news.
You do. In recent years, the sheer size of some executive pay packages, especially when you compare them to average worker earnings, has sparked considerable, often heated public debate. But beyond just the absolute numbers, there's a growing concern, highlighted in your study guide, about the perceived disconnect between this high pay and a company's long-term sustainable performance.
Right. Are they really earning it based on long-term value creation?
That's the question. And the global financial crisis really cast a harsh spotlight on this issue. It became painfully clear that many remuneration structures, often heavily based on short-term financial metrics, had inadvertently incentivized excessive risk-taking.
How so?
Well, executives might be encouraged to chase quick wins, perhaps through risky acquisitions or complex financial products, to hit those annual performance bonuses, even if those strategies ultimately jeopardize the company's long-term health or stability. As one commentator, Yao, put it quite effectively, these compensation schemes often, quote, induced extreme risk-taking without punishing failures, while focusing on short-term interests without aligning with a long view of risk.
That's a critical point, a misalignment of incentives. So what have been the practical responses to this intense scrutiny? We've seen the rise of, say, on-pay mechanisms. You mentioned the two strikes rule, and there's been a push for more robust best practice guidance, right?
Absolutely. In Australia, the UK, the US, and many other places, there are now significant disclosure requirements around executive remuneration. The idea is to offer greater transparency to shareholders and the wider community about exactly how much executives are being paid and, crucially, how that pay is determined.
And more recently, we're hearing about clawback and malice's policies.
Yes, these have become increasingly recommended and, in some cases, mandated elements of remuneration frameworks. They are designed specifically to allow companies to recoup excessive performance-based remuneration if things go wrong later on.
Okay, let's quickly unpack those terms because they sound similar but are different. Malice and clawback.
Right. Think of malice as essentially an adjustment before payment. It allows the board to reduce or cancel an executive's unvested bonus or share award money they haven't actually received yet if, say, subsequent performance turns out poorly, or misconduct is discovered, or the original basis for the award is found to be flawed.
Okay, so withholding something not yet paid.
Exactly. Clawback, on the other hand, is about taking back money that has already been paid or vested. This typically happens in more severe circumstances, like if it's later discovered that the financial results underpinning the bonus were materially misstated, or there was serious misconduct or negligence by the executive involved.
So clawback is literally getting the money back from their pocket.
Correct. Which, as you can imagine, makes it potentially more contentious, but also a very powerful tool for accountability.
Yeah. So if you were an executive, you'd probably be most worried about a clawback. As a shareholder, you'd likely support both mechanisms.
Generally, yes. From a shareholder perspective, both malice and clawback help ensure that remuneration is genuinely earned and properly aligned with ethical conduct and sustainable long-term performance, not just short-term or illusory gains. And these concerns have driven legislative changes. The Productivity Commission's extensive 2009 report on executive remuneration was highly influential in shaping reforms in Australia, including the two strikes rule. There was a growing sense, articulated by figures like Jan du Plessis, who was then chairman of Rio Tinto back in 2012, that the spiral in executive pay simply cannot continue. Many businesses sometimes appear to have lost all touch with reality.
Strong words.
They reflect a broader recognition, I think, that there are limits. Limits to how high salaries can climb without generating significant negative community reactions that can ultimately harm the corporation's reputation and, by extension, shareholder wealth.
So ideally, how should remuneration be structured? What about KPIs?
Ideally, key performance indicators, or KPIs, used for remuneration shouldn't just reward past performance. They need to be carefully designed to genuinely motivate and enhance future performance and align with long-term strategy.
Right.
For instance, share-based awards might be granted based on good past performance, but they could come with future performance hurdles or longer vesting periods that must be met before the executive unconditionally receives the shares or their value. This ties them to the company's sustained success.
What about those golden handshakes? Payments on leaving?
Boards and their remuneration committees also need to be extremely careful, and seem to be careful, about payments made upon early resignation or termination, those often controversially dubbed golden handshakes or golden parachutes. They need to ensure these payments are genuinely justifiable based on performance, contractual obligations, and crucially, respect broader shareholder and societal concerns about perceived excess.
And we're seeing similar regulatory efforts internationally.
Oh, definitely. These concerns are global. In the U.S., for example, the Dodd-Frank Act, passed after the GFC, introduced a non-binding shareholder vote on executive compensation, the say-on-pay vote. And U.S. firms are now required to disclose the ratio between their CEO's compensation and the median compensation of all their other employees.
That ratio must be interesting reading sometimes.
It certainly generates discussion. Similarly, in the UK, investors now have a legally binding vote on future executive pay policy, giving them even more direct power than the advisory votes in the US or Australia's two-strike system.
But does all this disclosure actually work to moderate pay? Or could it backfire?
That's the counter-argument you sometimes hear. Some commentators suggest that widespread disclosure might, paradoxically, lead to higher executive pay overall, not lower.
How could that happen?
The theory is rooted in benchmarking. When everyone knows what everyone else is paying, remuneration committees, often advised by consultants, might feel pressure to pay at least the market median, or, more likely, aim for above-average market pay to attract and retain talent. If everyone does that, the average keeps ratcheting upwards.
A sort of Lake Wobegon effect for CEO pay? Everyone's above average?
Something like that, yes. If this theory holds water, then mechanisms like Australia's two-strikes rule, which provide a direct consequence for shareholder dissatisfaction, become even more crucial as a potential counterbalance to any reporting-induced salary inflation. We saw the power of shareholder votes even before the two-strikes rule fully kicked in. Remember the Telstra example from 2008?
Ah, yes, the departure payment.
Exactly. A proposed $10.7 million departure payment for its outgoing CEO was actually voted down by shareholders at the AGM. These high-profile cases really highlight the ongoing tension between boards, executives, and shareholders over pay, and the importance of shareholder vigilance and the tools they have available. The CHEMAC report in 2011 also heavily emphasized aligning pay with actual performance.
And the study guide includes example 4.3 about Cisco CEO John Chambers, highlighting reports calling him overpaid relative to stock performance. What's the takeaway there?
That example serves to illustrate how executive pay is often analyzed, sometimes quite critically, in the financial press relative to company performance, often measured by total shareholder return, TSR. It also points out the sometimes emotive language used in these reports, eye-popping, flabbergasting. For your exam, it's less about agreeing or disagreeing with the assessment of Chambers' pay and more about understanding how remuneration is scrutinized, the metrics used, like TSR, and the role of shareholder advisory groups and media in this debate. It also prompts thinking about question 4.3, which asks you to consider severance payments using BHP's remuneration committee terms as a reference, again, focusing on the governance processes around these potentially sensitive payments. Okay, let's pivot now to another absolutely critical area of governance and practice, audit responsibilities and regulatory compliance. If we connect this back to the bigger picture, the integrity of a company's financial information is just paramount. Trust depends on it. And that's precisely where the audit function, particularly the external audit, steps in.
That makes perfect sense. So let's unpack this a bit. The regulatory landscape, as you'd expect, demands meticulous attention to financial reporting. The Corporations Act, for instance, lays out key provisions. Sections 296 and 297 are mentioned requiring financial statements to give a true and fair view of a company's financial performance and position.
True and fair view, that's the cornerstone.
Exactly. And the Act explicitly discourages practices like earnings management or, window dressing, the financial statements to make them look more favorable than they actually are. Doing so directly contradicts a director's fundamental obligations of care and diligence.
And this is where understanding the distinct roles of internal and external auditors becomes absolutely crucial. While internal auditors play a vital role within the company focusing on ongoing compliance, risk management, and internal fraud controls, the external auditor is that independent third party. Their job is to provide a professional, objective opinion on whether the financial statements, prepared by management and overseen by the board, present that true and fair view in accordance with accounting standards.
And their independence is key.
Non-negotiable, absolutely critical. External auditors are required by professional standards to exercise professional skepticism. That means they must approach the audit with a questioning mind, critically assessing the validity and sufficiency of all the audit evidence they gather. They can't just take management's assertions at face value.
Can auditors be held liable if things go wrong?
Yes, they can. Auditors can be held liable for negligent misstatements if they fail to conduct the audit with due care and skill, or fail to obtain sufficient appropriate evidence to support their opinion. However, it's important to remember the primary liability for materially incorrect or misleading financial information always rests with the company's directors and management. They prepare the statements, the auditor audits them.
Right. Now, a truly classic, albeit, as you said before, tragic example that perfectly illustrates the dangers of compromised auditor independence is the infamous Enron failure and the subsequent collapse of its auditor, Arthur Andersen.
A watershed moment in auditing history.
Absolutely. Arthur Andersen wasn't just Enron's auditor. They also provided extensive and very lucrative non-audit consulting services. They were billing Enron tens of millions of dollars for both audit and non-audit work.
A huge conflict of interest.
Exactly. This arrangement severely blurred the lines, created a clear financial dependency, and ultimately, as investigations revealed, compromised their professional skepticism and independence. It contributed significantly to their failure to detect or report the massive fraud at Enron, and ultimately led to the firm's demise.
Indeed. And the auditing standards globally have evolved significantly since Enron, largely in response to that failure and similar scandals. There are now much stricter obligations on auditors to identify, evaluate, and address threats to their independence. For instance, there are rules around the proportion of fees that can come from non-audit services for an audit client, and stricter rules on auditor rotation.
And who do they report to?
Critically, auditors are now explicitly required to report directly to the board's audit committee, which should ideally consist of independent, non-executive directors, not primarily to management like the CFO or CEO. This reporting line is designed to further safeguard their independence from management pressure.
And we've seen consequences in other cases, too. The Centro case is mentioned.
Yes, the Centro case in Australia is another powerful, real-world illustration. Central Properties Group failed to disclose billions of dollars of short-term debt in its financial statements. While the primary fault lay with the directors, Centro's auditor, PricewaterhouseCoopers, eventually agreed to pay almost $70 million as part of a settlement with shareholders. This demonstrated significant auditor liability when failures contribute to investor losses, reinforcing the critical importance of clear disclosure and diligent auditing.
It's clear then that the review of audit quality and the regulations surrounding it is an ongoing dynamic process. AS, as the corporate regulator in Australia, actively conducts audit firm inspection programs. What do they look for?
They examine how the major audit firms regulate their own auditing processes. They assess whether the firms comply with auditing standards and relevant laws. Specifically, ASIC reports, like INFO 222 mentioned in the guide, focus on factors like the firm's internal culture. Is there a genuine focus on audit quality? Do they have adequate resources and expertise? Is there effective supervision and review of audit work? And critically, how do they identify and address audit risks and findings?
And what have these inspections found? Has quality improved?
Well, ASIC's public reports have, frankly, persistently found weaknesses over several years. Their reports have noted ongoing issues in key, high-risk audit areas like the valuation of assets, especially goodwill and intangibles, and revenue accounting. Perhaps more concerningly, they've even found instances of non-compliance with independence requirements among some of the largest audit firms.
Still, even after all the reforms.
It appears so, based on ASIC's findings. These persistent findings, coupled with some high-profile corporate collapses where audit quality was questioned, even led to a parliamentary joint committee inquiry into audit regulation in Australia a few years ago. This was sparked by broader concerns about whether audit quality was declining and whether the regulatory framework was effective enough. There were differing views expressed, for instance, between the UK regulator, the FRC, and ASIC on the extent of the problem. Which brings us neatly to question 4.4 from the study guide. What are some measures the board can undertake to enhance the likelihood of auditor independence? This is a crucial question because it shifts the focus from just what the auditor must do to what the corporation, specifically the board and its audit committee, can proactively do internally to foster and protect that independence.
Right. So it's not just relying on the auditor's own statement.
Exactly. That's necessary, but not sufficient. The board has an active role, so what can they do? Firstly, the board, through its audit committee, needs to establish crystal clear understandings and robust policies regarding the auditor's role, scope, and reporting lines. As we said, ensuring they report directly to the audit committee, which ideally should comprise a majority, if not all, independent non-executive directors.
Okay, clear reporting lines. What else?
Secondly, the board should closely monitor the fees paid to the auditor, ensuring that a significant portion comes from audit services rather than an excessive reliance on potentially more lucrative non-audit services. This helps avoid creating a financial dependency that could subtly compromise independence.
Fee monitoring. Makes sense.
Thirdly, they should consider policies around audit firm rotation, or at least the rotation of the key audit partners involved with the company, perhaps every 5 to 7 years. This helps bring fresh perspectives and reduces the risk of overfamiliarity breeding complacency or impairing skepticism.
Okay, rotation. What else?
Fourthly, and this is perhaps more cultural, the board and senior management should actively foster a corporate culture that genuinely respects and values auditor independence. This means avoiding any attempts to unduly influence, pressure, or control audit findings or processes. The tone at the top matters immensely here.
Culture of respect. Good point.
Finally, the board has a responsibility to ensure that the company's own internal control systems are robust and effective. Why? Because strong internal controls make the external audit process smoother, more efficient, and inherently less risky. They reduce the chances of material misstatements occurring in the first place, which in turn eases potential pressure points between management and the auditor. So it's really a proactive, multifaceted approach the board needs to take.
That's really helpful. So stepping back a bit, what does all this mean beyond just avoiding financial collapse and ensuring the books are accurate? What are the proactive steps for genuinely better governance overall? Your study guide points to two particularly key recommendations here: more rigorous risk management and ensuring an independent chair for the board.
Yes, let's start with risk management. Now, Standard Australia and IFAC define risk management broadly. It's the culture, the processes, the structures that are directed towards realizing potential opportunities whilst managing adverse effects. It's not just about preventing bad things, it's about optimizing outcomes.
Okay, so it's both sides of the coin.
Exactly. Maximizing opportunities while minimizing losses of all types. And the board's role here is absolutely critical. They must establish and oversee a robust framework to systematically identify, analyze, evaluate, treat, monitor, and communicate risks across the entire organization.
What kind of risks are we talking about?
It's incredibly broad. It could be anything from operational risks, financial risks, strategic risks, compliance risks, to reputational risks. Think about legal liability for environmental damage, the devastating Bhopal gas disaster, or the BP Deepwater Horizon oil spill are extreme examples. Or managing financial market volatility, cybersecurity threats, supply chain disruptions. The list is long. The ASIC principles, specifically Principle 7, directly link good governance to establishing and regularly reviewing a sound risk management framework and internal control system.
And internal controls are part of this.
Definitely. Good internal control and risk systems are vital components of the overall risk management framework. This includes having robust accounting systems to ensure accurate and timely information flow. It includes having a strong internal audit function that provides independent assurance on compliance, risk management effectiveness, and internal fraud controls. And it involves having effective risk control systems embedded in operations to manage and enforce board policies.
You mentioned fraud controls. How significant is that?
Combating fraud is a major governance responsibility. Fraud can obviously cause significant financial losses, but also immense reputational damage. Many countries have dedicated bodies and legislation focused on fraud prevention and control. Australia, for example, has its Commonwealth Fraud Prevention Centre working on standards, and key legislation like the Public Governance Performance and Accountability Act, PGPA Act, and the Public Interest Disclosure Act, PID Act, aim to strengthen anti-fraud capabilities and protect whistleblowers, particularly in the public sector, but the principles apply broadly.
And it's really important to stress, isn't it, that these governance issues aren't just for huge listed corporations. They apply across all sectors. The study guide gives examples from the Australian Charities and Not-for-Profits Commission, ACNC.
Yes, Those examples, 4.6, 4.7, 4.8, are powerful reminders. The ACNC regularly reports on investigations into fraud and governance problems within charities and NFPs. We've seen cases highlighted where employees misuse charity credit cards for purely private purchases, instances of serious financial mismanagement, or conflicts of interest where, say, founders or directors improperly benefited financially from charity assets because the board failed in its duty to protect the charity's interests.
So the standards are just as vital there.
Absolutely. These examples powerfully reinforce that rigorous governance standards, transparent financial reporting, clear conflict of interest policies, and strict accountability are imperative across all sectors, not just the for-profit world. The fundamental principles of good governance are universal. Precisely. And the overarching point, as your study guide really emphasizes towards the end of this section, is that each element of governance needs to be working properly to ensure that a company is run according to best practice and that conduct within an entity is ethical. It's like a chain. Any single failure, any weak link in a company's internal controls or other governance mechanisms can create significant gaps, opening the door for corporate misconduct or failure to occur. It's truly a holistic ecosystem where all the parts must function effectively in concert.
Okay, now here's where it gets really interesting, I think. Because the guide makes a strong link between good governance and actually understanding the legal system itself. We're not talking about needing to be lawyers, obviously, but appreciating the foundational role that law plays in all aspects of corporate life. It's the framework, the rule book, within which everything else operates.
That's a great way to put it. In legal systems derived from English common law, so Anglo-American systems like Australia, the UK, the US, Canada, New Zealand, and others, laws originate from two main sources: from courts, through the precedents set by their decisions over centuries, and from legislation passed by parliaments or legislatures.
Right. Common law and statute law.
Exactly. And some of the most fundamental laws that underpin modern corporate life initially emerged from court decisions, but have since been refined and codified through extensive legislation. Think about individual rights, especially for employees. The law of contracts, which governs almost all business transactions. The law of negligence, dealing with duties of care, property rights, ownership rights, and, critically, insolvency arrangements when things go wrong. These provide the essential structure.
And there's a mutual dependence between the economy and the law.
Absolutely. The economy and the legal system are deeply intertwined and mutually dependent. Corporations thrive best in a stable, well-regulated economy, and laws are specifically designed to protect fair competition, ensure integrity and confidence in financial markets, and safeguard fundamental individual rights. Conversely, for our capital-based economies to succeed, the legal system must provide a predictable, fair, and reliable environment that encourages investment, innovation, and corporate success. A strong, independent, and accessible court system is absolutely vital for ensuring rights are protected and that there's a clear path to seek redress when wrongs are committed.
So for anyone involved in governance, directors, executives, advisors, understanding the fundamental difference between civil law and criminal law isn't just an academic exercise. It's absolutely foundational to navigating the risks and responsibilities.
It truly is. They operate quite differently. Civil law, broadly speaking, deals with disputes between private parties, individuals, or organizations. Think contract breaches, negligence claims leading to damages, property disputes. The aim is usually to resolve the dispute and provide a remedy, often financial compensation, for the wronged party.
Okay, disputes between parties and criminal law.
Criminal law, on the other hand, focuses on acts considered harmful to society as a whole, offenses against the state. Things like theft, fraud, assault, and specific corporate crimes like insider trading or market manipulation in some contexts. Here, the state, through prosecutors, takes action against the alleged offender. The primary aims are punishment, deterrence, and protecting the public.
And the standard of proof is different.
Critically different. This is a key distinction. In criminal cases, the prosecution must prove the accused's guilt beyond reasonable doubt. That's a very high standard, reflecting the serious consequences, which can include imprisonment, and criminal intent, or mens rea, is usually a necessary element to prove.
Okay, beyond reasonable doubt. And civil.
In civil cases, the standard of proof is much lower. Balance of probabilities. The court simply needs to be satisfied that it's more likely than not, say, 50.1% certain that the defendant is liable. Neither party faces jail time or traditional criminal fines in purely civil cases. Instead, courts might award financial damages to compensate the plaintiff issue injunctions to stop certain conduct, or order things like contract rescission. And importantly, legal costs often follow the event, meaning the losing party typically pays a significant portion of the winner's legal fees.
Now, the guide mentions civil penalties or pecuniary penalties. How do they fit in? They sound a bit like fines.
This is a really important and sometimes confusing development, particularly in corporate and regulatory law over recent decades. Legislatures have created provisions where certain breaches of legislation, often serious breaches of director duties or competition law, are treated as civil matters, meaning they only need to be proven on the balance of probabilities.
Lower standard of proof.
Exactly. But the consequence can be a very large monetary penalty payable to the state. These are called civil penalties or pecuniary penalties. They are not criminal fines, even though the amounts can be huge, sometimes millions of dollars.
Okay, so civil cruise standard, but a penalty paid to the state.
Correct. The Vizard case, mentioned in example 4.9, is a classic illustration. Steve Vizard, a former Telstra director, was found to have breached his director duties by misusing confidential information. It was pursued as a civil case by ASIC. He received a 10-year ban from managing corporations and had to pay substantial pecuniary penalties. No criminal conviction, but significant consequences nonetheless. The press often confusingly calls these penalties fines, but for your understanding, it's crucial to grasp they arise from civil proceedings.
Right. And how does redress fit in?
Redress is more of a general, non-legal term for correcting harm or providing a remedy to someone who has suffered loss. Financial damages paid to an injured party in a civil suit are a form of redress. The Centro case settlement, where shareholders received agreed damages due to the company's failure to accurately disclose its liabilities, is an example of redress achieved through civil litigation. Other civil remedies that aren't necessarily redress but are still consequences include things like adverse publicity orders or court orders prohibiting someone from managing corporations, like Vizard's ban, all distinct from criminal penalties like jail time.
Given all these potential legal pitfalls, civil actions, pecuniary penalties, regulatory actions, even criminal charges, in some cases, the costs of noncompliance can be absolutely immense, can't they? And they surely extend far beyond just the legal penalties themselves.
Oh, vastly beyond. The study guide highlights this well. Think about the significant internal human resource costs involved: staff time spent locating documents, preparing reports, attending interviews for investigations. Then there are the often astronomical external legal advice fees.
Yeah, they can add up quickly.
Hugely. And then there's the potentially devastating impact of negative publicity on the company's reputation, its brand value, employee morale, customer loyalty, its share price, and ultimately its bottom line profitability.
A ripple effect.
A massive ripple effect. You also have the significant diversion of management time and effort away from core value-creating business activities towards dealing with the investigation or litigation. And don't underestimate the sheer stress imposed on managers and employees involved, which can lead to burnout, absenteeism, or even key people resigning. It's a cascading series of negative consequences that can truly cripple an organization, far outweighing any perceived short-term gain from cutting corners. And that's precisely why the concept of a proactive compliance program is so vitally important in modern governance. Professor Alan Fels, a former chairman of the ACCC, defined it quite effectively. A compliance program is essentially a systemic approach embedded within the business designed to assess and reduce an organization's risk of breaking the law. It's about fostering a culture of good corporate citizenship.
So it's more than just a policy document sitting on a shelf.
Much more. It's not just a one-off training session or a tick-box exercise. To be effective, it must be an integrated business system with clearly defined responsibilities, adequate resources, regular training, ongoing monitoring, and crucially, audited procedures to ensure it's actually working in practice.
What are the main benefits?
There are two key benefits. Firstly, and most obviously, it helps the company avoid breaking the law in the first place. This saves significant time and money by reducing the risks of penalties, legal costs, and limiting liability for damages if something does go wrong despite best efforts.
Prevention is better than cure.
Exactly. Secondly, a well-designed compliance program can actually enhance business operations. By clarifying rules and responsibilities, promoting ethical conduct, and focusing on risk prevention, it allows the company and its people to focus more effectively on positive business purposes rather than constantly reacting to compliance failures or managing crises. And increasingly, courts and regulators are recognizing effective compliance programs as a mitigating factor when considering outcomes or penalties for breaches, underscoring their strategic importance.
Okay, let's unpack another really critical aspect of governance in practice: the organization's obligations toward its employees. They are absolutely central stakeholders in any organization, aren't they? And protecting their rights and well-being is a key governance responsibility.
Couldn't agree more. This means having clear, fair, and legally compliant policies that ensure appropriate employer-employee relationships across the board.
And a critical area highlighted in the guide is whistleblower protection.
Yes, this has become increasingly prominent in governance discussions. Your study guide uses a definition from Mycelian Neer, 1984, essentially. Whistleblowing is the disclosure by current or former organization members of illegal, immoral, or illegitimate practices under the control of their employers to persons or organizations who actually have the power to take action and effect correction.
Why is this so significant?
Its significance really cannot be overstated. Often, whistleblowers are the only effective mechanism to uncover serious internal misconduct that might otherwise remain hidden. This can range from critical occupational health and safety breaches that put lives at risk, to environmental damage, to major financial fraud or corruption.
But it's historically been risky for the whistleblower.
Immensely risky. Historically, whistleblowers faced huge personal risks. They were often vilified as disloyal daubers, faced dismissal, demotion, ostracism from colleagues, sometimes even legal action from the employer. Tragically, there are even anecdotal cases linked to suicide due to the pressure and lack of support.
So things have changed.
Thankfully, yes. Modern legislative protection, developed over recent decades, is designed to allow whistleblowing to occur in a more managed, structured, and safer way. It started, interestingly, way back in the U.S. in 1863 with the False Claims Act during the Civil War, aimed at government contract fraud. Since then, whistleblower protection laws have become common internationally, expanding beyond just government interests to cover private sector wrongdoing, particularly in areas like occupational health and safety laws initially, and now much broader corporate misconduct.
And in Australia.
In Australia, the Corporations Act was significantly updated, with Part 9.4 ALA coming into full effect around 2019, providing much more robust protection for corporate sector whistleblowers. This legislation covers disclosures about suspected breaches of the Corporations Act itself, related regulations, or even breaches of accounting standards. It offers substantial protections against detrimental conduct towards the whistleblower, allows for anonymous reporting in many circumstances, and, crucially, imposes harsh penalties, including jail time, for victimization or retaliation against legitimate whistleblowers. This modern, comprehensive approach is a really valuable addition to the corporate governance toolkit, enabling the exposure of misconduct that might otherwise fester unseen.
And beyond specific whistleblower laws, there's a whole raft of broader workplace relations laws that boards and management must be intimately aware of and ensure compliance with.
Absolutely. This includes foundational legislation like Work Health and Safety Acts, often abbreviated as WHS or OHS, which impose duties on businesses and their officers to ensure, so far as is reasonably practicable, the health and safety of workers and others affected by the work. Then you have laws like the Fair Work Act in Australia, covering things like minimum wages, employment conditions, unfair dismissal, and collective bargaining. And of course, anti-discrimination laws like the Disability Discrimination Act, ensuring non-discrimination in hiring, promotion, and treatment in the workplace. These laws cover the entire life cycle of the employment relationship.
And the consequences of noncompliance can be severe, as some examples show.
Yes, the study guide provides some stark and often tragic examples, like 4.11, 4.13, 4.15, of what happens when these obligations aren't met. There was the case of a scrap metal business owner who was actually jailed and personally fined hundreds of thousands of dollars after a fatality for failing to provide a safe work environment under OHS laws. This emphasizes that WHS is not just a peripheral compliance issue, it's a core responsibility with potentially criminal consequences for directors and officers.
And the underpayment case.
Another example involved a security business owner being penalized significantly for underpaying interns and guards, falsely classifying them to avoid paying lawful entitlements. It highlights that you can't just use labels like intern or contractor to bypass fundamental obligations around fair pay and conditions under the Fair Work Act. Accessorial liability means individuals involved in the contravention can be held personally liable too.
But perhaps the most powerful and tragic example mentioned is the Pike River coal mine disaster in New Zealand.
Indeed. 29 miners tragically lost their lives in an underground explosion in 2010. The subsequent Royal Commission report was scathing about the company's safety practices and governance. It explicitly stated, and this is a direct quote worth remembering, "Protecting the health and safety of workers is not a peripheral business activity. It is part and parcel of an organization's functions and should be embedded in an organization's strategies, policies, and operations. This requires effective corporate governance." The Commission directly attributed the tragedy to fundamental failures in risk management, communication, and board oversight, clear governance failures.
A devastating reminder.
Absolutely. And beyond the immediate human tragedy and potential legal consequences, workplace injuries and fatalities, or even widespread underpayment scandals, severely affect a business in other ways. They lower productivity, can lead to loss of contracts or sales, seriously damage employee morale and make it hard to attract talent, and significantly diminish public respect and brand reputation. It all reinforces that boards have a solemn, non-delegable duty to ensure these issues are appropriately governed and managed, embedding a genuine culture of safety and fairness throughout the organization.
Okay, so shifting perspective again, what does all this governance focus mean for market dynamics more broadly? It seems a key aim is ensuring a fair and competitive environment for everyone involved. We're talking about workable competition.
That's right. While economists might talk about perfect competition as a theoretical ideal, in the real world, most modern economies and competition laws aim to achieve and maintain what's called workable or effective competition.
What does that actually mean in practice?
It means ensuring a market structure and conduct that promotes rivalry and efficiency. The study guide outlines several key requirements for workable competition. There should be a sufficient number of buyers and suppliers so that real alternatives exist for most participants. No single trader, buyer, or seller should be so powerful that they can dictate terms or act completely immune from competitive pressure from rivals or new entrants.
So no monopolies or dominant players abusing their position.
Essentially, yes. And critically, new players should be able to enter the market without facing artificial or insurmountable barriers erected by incumbents. There should be no collusion, no secret agreements between competitors to limit competition between them. Customers should always have genuine choice between suppliers based on price, quality, and service. And importantly, no trader should have an unfair legal or political advantage over others.
What's the main benefit of striving for this?
The core benefit is that genuine competition relentlessly pushes corporations to become more efficient, more innovative, and more responsive to customer needs. This ultimately leads to better products and services, lower prices, and greater choice for consumers. And on a macro level, it drives broader economic benefits through increased productivity, growth, and resource allocation efficiency. It's seen as fundamental to a well-functioning market economy.
And to achieve and protect that workable competition, there are clear legal prohibitions on specific types of anti-competitive conduct. Let's unpack a couple of the major ones outlined in the guide. First, abuse of market power.
Right. This is covered by Section 46 and 46A of the Competition and Consumer Act in Australia, and similar laws exist globally. It doesn't prohibit a company from having market power. Being big isn't illegal in itself. What it prohibits is a powerful entity taking advantage of that market power for certain anti-competitive purposes.
Such as
Eliminating or substantially damaging a competitor, preventing potential competitors from entering the market, or deterring or preventing a rival from engaging in competitive conduct. A classic example of misuse of market power is predatory pricing, where a dominant firm deliberately supplies goods or services below its relevant cost for a sustained period, specifically to drive smaller competitors out of business so it can later raise prices. And the ACCC, the Australian Competition and Consumer Commission, actively enforces these provisions. The CabCharge case mentioned, example 4.16, is a good illustration. CabCharge received a hefty $14 million penalty for abusing its dominant position in the taxi electronic payment system market by refusing to deal with competitors and potential competitors, effectively locking them out. These cases demonstrate that while having market power isn't illegal, how that power is used is absolutely critical and subject to strict legal scrutiny.
Okay. What about mergers and acquisitions? They can reduce the number of players.
Yes, M&A activity is also closely regulated under competition law, Section 50 in Australia, specifically to prevent mergers or acquisitions that would have the effect, or likely effect, of substantially lessening competition in a relevant market. Regulators like the ACCC review significant proposed mergers.
But sometimes mergers are allowed, even if they involve large companies.
Yes, because the test is whether they substantially lessen competition. Sometimes a merger might be cleared if it doesn't reach that threshold, or even, paradoxically, if it's argued that it might strengthen competition overall. The Metcash case, example 4.20, is an interesting example cited. Metcash, a large grocery wholesaler, acquired a rival wholesaler. The ACCC initially had concerns, but ultimately allowed it, partly on the basis that a stronger Metcash might enable the independent retailers it supplied, like IGA stores, to compete more effectively against the dominant major supermarket chains, Kohl's and Woolworths. So it was seen as potentially increasing competition at the retail level.
That highlights just how complex these assessments can be, involving detailed market analysis. Now, another type of conduct considered highly inappropriate, often attracting the most severe penalties, is agreements between competitors, often referred to collectively as cartel conduct.
Yes, this is generally viewed as the most serious form of anti-competitive conduct because it involves competitors who should be actively competing against each other on price, service, and innovation, instead secretly conspiring with each other to undermine the competitive process for their mutual gain, usually at the expense of customers.
Why is it penalized so severely?
Because it strikes at the very heart of the market mechanism. It artificially inflates prices, restricts output, reduces choice, and stifles innovation. Because it's inherently secretive and harmful, cartel conduct typically attracts massive civil pecuniary penalties. And importantly, in many jurisdictions now, including Australia, the US, the UK, and the EU, engaging in serious cartel conduct can also lead to criminal sanctions for both the corporations involved and the individuals responsible, including hefty fines and potential jail time for executives.
Wow, criminal charges too. What are the main types of cartel conduct?
The legislation usually identifies four main types. First is output restrictions, where competitors agree to limit the production or supply of goods or services to artificially create scarcity and drive up prices. Think of OPEC, the oil cartel, as a global example of attempting this. Second is allocating customers, suppliers, or territories. This is essentially market-sharing competitors agreeing not to compete for certain customers or in certain geographic areas, effectively creating local monopolies for themselves. Third is bid rigging, where competitors secretly collude on tenders or bids, for example, by agreeing who will submit the winning bid, or by submitting inflated cover bids to create a false impression of competition. This often happens in government procurement or construction projects. And finally, the most common form, perhaps, is price fixing, where competitors simply agree on the prices they will charge, or agree on formulas for setting prices, or agree to coordinate price increases, thereby eliminating price competition between them.
We've seen some huge fines for this globally, haven't we? The study guide mentions Visi and the International Airline Cartel.
Yes, those are significant examples. Visi Industries in Australia received a record $36 million fine for price fixing and market sharing in the cardboard box market with its rival Amcor. And the International Air Cargo Cartel involved numerous major global airlines colluding on fuel and security surcharges over several years, resulting in hundreds of millions, possibly billions of dollars in fines and settlements worldwide. Examples 4.21, 4.22. These cases really underscore the global reach and severity of cartel enforcement efforts.
Okay, what about restrictions imposed by suppliers on distributors, like exclusive dealing or resale price maintenance?
Right, these are sometimes kind of vertical restrictions, as they occur between different levels of the supply chain, unlike cartels, which are horizontal between competitors. Exclusive dealing generally involves a supplier imposing restrictions on a distributor's freedom to choose who they deal with, where they deal, or what products they deal in. For example, requiring a retailer to only stock the supplier's brand or only sell within a specific territory. Generally, exclusive dealing is only prohibited if it has the purpose, effect, or likely effect of substantially lessening competition. So unlike cartels, there's a competition test applied. It usually only attracts civil consequences.
Okay, so it depends on the impact. What about resale price maintenance, RPM?
RPM is different. This occurs when a supplier specifies a minimum price below which a reseller, like a retailer, cannot advertise or sell the supplier's product, and takes action to enforce that minimum price. In many countries, including Australia, RPM is typically considered per se illegal.
Per se illegal,
Meaning, you don't need to prove it had an anti-competitive effect. The conduct itself is prohibited outright, regardless of its impact on the market. The rationale is that it prevents retailers from competing on price for that particular product, ultimately harming consumers. The chemical formulators case mentioned, PDF Folio Tot 271, is an example where a supplier was penalized for attempting to stop distributors from discounting its products. RPM usually attracts civil penalties.
But aren't there exceptions or ways to get approval for potentially anti-competitive arrangements if they have public benefits?
Yes, absolutely. Most competition laws include procedures for businesses to seek authorization or notification for conduct that might otherwise breach the rules if they can demonstrate that the conduct delivers a net public benefit that outweighs any anti-competitive detriment.
How does that work?
For authorization, the business applies to the regulator, like the ACCC, who conducts a public consultation process and makes a determination. For notification, particularly for some types of exclusive dealing, the business lodges a notification, and the legal protection begins unless the regulator objects. A common example where authorization is often granted is for franchising arrangements, example 4.23. While franchising might involve territorial exclusivity or restrictions on sourcing supplies, sometimes called third-line forcing, these restrictions are often seen as necessary for the franchise system to work effectively and can actually enhance competition overall by enabling more small businesses to operate under a strong brand. Example 4.24 presents a hypothetical, Shark Ltd, Loose Ltd, and a real case, Taylor's Wines, prompting you to think about potential breaches, penalties, and when conduct might be permissible, reinforcing the need to analyze the specific conduct and its context. Question 4.6 asks you to apply these concepts. Now, shifting our focus slightly again, let's consider the obligations companies have towards their consumers and customers. What's fascinating here, and a recurring theme in governance, is how corporate responsibility and good governance extend well beyond just shareholders and regulators to encompass every individual and entity interacting with the company, particularly consumers.
And protecting consumers isn't just about legal compliance, is it? It's good business, too.
Absolutely. While we typically think of consumers in the legal sense as individuals buying goods or services for personal, domestic, or household use, modern consumer protection laws are increasingly extending safeguards to cover business consumers as well, particularly small businesses buying goods or services. The underlying principle is that good corporate conduct towards consumers being fair, honest, transparent, builds trust, strengthens brand loyalty, enhances reputation, and ultimately adds significant value for shareholders and society as a whole. Conversely, mistreating customers is a fast track to business failure.
A key focus of consumer protection law is preventing misleading conduct and representations. What does this involve?
This is a really broad prohibition found in consumer laws globally, like Section 18 of the Australian Consumer Law. It's not just about outright lies. The law focuses on the overall impression created by conduct or representations. It asks whether the conduct, viewed as a whole in its context, is likely to mislead or deceive a reasonable member of the target audience.
So it's about the impression, not just literal truth.
Precisely. The law considers whether less informed or more vulnerable members of the community might be misled. It's fundamentally about fairness in commercial dealings, as highlighted in Table 4.5. A statement might be literally true in isolation but still misleading if important information is omitted or if the context creates a false impression.
The Apple 4G iPad case you mentioned earlier, example 4.25, seems like a perfect illustration of this.
It is. Apple was penalized millions of dollars in Australia for advertising its new iPad as being 4G compatible, even though it wasn't compatible with Australia's actual 4G LTE network at the time. Apple argued it was using globally consistent marketing, but the court found it was misleading to Australian consumers in the specific Australian context. The court emphasized that designers of global campaigns need to be attuned to the understandings and perceptions of Australian consumers. It's a powerful reminder about context and overall impression.
That leads nicely into question 4.7, the hypothetical about the highest carbohydrate sports drink. If the advertiser claims this stimulates endurance based on scientific analysis, but the researchers later say any difference between brands was statistically insignificant for stamina, has the advertiser engaged in misleading advertising?
It's a great question for testing understanding. Based on the principles, it very likely has engaged in misleading conduct. Why? Because even if it's literally true that it has the highest carbohydrate level, the overall impression created, particularly by linking it to stimulating endurance based on scientific analysis, strongly implies a performance benefit that the researchers themselves apparently refute as statistically insignificant. The advertiser seems to be omitting crucial qualifying information, creating a misleading impression about the drink's proven effect on stamina compared to others. It highlights the danger of relying on selective truths or half-truths in advertising.
What about puffery? Where's the line?
Puffery. That refers to wildly exaggerated, obviously fanciful, or vague claims that a reasonable person wouldn't take literally. Think, best coffee in the world. Generally, mere puffery is not considered misleading conduct because it's not intended to be relied upon as a factual statement. However, the line can be tricky. If a claim, even if slightly exaggerated, takes on a specific factual character, especially regarding quality, features, price, or benefits, it moves out of puffery and absolutely must be accurate and capable of substantiation. Another really important concept in consumer and increasingly business-to-business dealings is unconscionable conduct.
Unconscionable, meaning
Essentially means conduct that is so harsh or oppressive that it goes against good conscience. These laws, found in the Australian consumer law, for example, are designed primarily to protect vulnerable parties from exploitation resulting from unfair tactics or unfairly imposed contract terms, especially where there's a significant imbalance in bargaining power.
so it's about stopping powerful parties taking unfair advantage of weaker ones.
Exactly. But it's important to note, these protections aren't just for individual consumers anymore. In many jurisdictions, they now explicitly apply to business B2B transactions as well, particularly involving small businesses dealing with larger corporations. Think commercial leases, building contracts, franchising agreements, and even financial services contracts.
What factors do courts look at to decide if conduct was unconscionable?
Courts consider a whole range of factors listed in the legislation. These include the relative bargaining strengths of the parties, whether the weaker party was required to comply with conditions not reasonably necessary to protect the supplier's legitimate interests, whether the weaker party could understand the documents, whether any undue influence, pressure, or unfair tactics were used, the terms and conditions of the contract compared to industry norms, the extent to which the supplier was willing to negotiate, the supplier's good faith, and whether the supplier had a unilateral right to vary the contract, among other things. It's a broad assessment of whether the overall conduct was fair and reasonable in all the circumstances.
Okay, now here's where it gets really interesting and incredibly relevant today. The digital age adds an entirely new and critical layer of corporate responsibility, particularly concerning data privacy.
It absolutely does. This has become a massive area of focus for governance and risk management. Businesses today collect, store, use, and eventually must securely dispose of vast amounts of personal information, not just about their customers, but often about their employees too.
And the obligations are significant.
Immense. There are legal obligations, often stemming from comprehensive privacy legislation like the Privacy Act 1988 in Australia or GDPR in Europe, govern how this personal information must be handled. This includes rules around obtaining consent, ensuring data security, limiting use and disclosure, providing access and correction rights to individuals, and managing data breaches.
And the consequences of getting it wrong.
They can be severe. Data breaches can lead to significant customer attrition, loss of trust, reputational damage, regulatory investigations, large fines, and potentially class action lawsuits. The financial and operational impacts can be substantial.
Australia introduced a notifiable data breaches scheme.
Yes, the NDB scheme commenced in 2018. It requires organizations covered by the Privacy Act to notify both the individuals affected and the Privacy Commissioner if they experience a data breach that is likely to result in serious harm. This transparency requirement puts significant pressure on organizations to have robust data security measures in place.
And changes are proposed?
Yes, following several major high-profile data breaches in Australia in 2022, the government released a comprehensive Privacy Act review report in early 2023 proposing significant reforms. These aim to strengthen the regime by potentially broadening its application, for example, removing the small business exemption in some cases, increasing entities' obligations around data handling and security, expanding individual rights like rights to erasure and objection, and significantly increasing enforcement powers and penalties for noncompliance. While these are still proposals, the direction of travel is clear. Data privacy is becoming an even more critical governance and compliance issue for boards and management to oversee effectively. There are some exemptions, like for small businesses currently, and specific rules around sensitive data like tax file numbers, but the overall trend is towards greater responsibility. Okay, let's broaden our lens again now to think about how corporate governance connects to the protection of financial markets and the value in corporations. If we connect this to the bigger picture, good governance isn't just about how a company runs itself internally. It's also fundamentally about how it operates within the broader financial markets, ensuring its actions protect not just its own value, but also contribute to overall market integrity and stability.
And the regulation of these markets has become increasingly complex, hasn't it? Especially after major corporate collapses or crises.
Incredibly so. Financial market regulation operates at both domestic and global levels, and it's constantly evolving. The complexity arises from the interconnectedness of markets, the sophistication of financial products, and the need to maintain investor confidence, which is easily shaken by scandals or systemic failures.
So, who are the key players, the main regulatory bodies involved in overseeing these markets, at least in the Australian context outlined in the guide?
The study guide provides a helpful overview, Table 4.6. You have several critical regulators with distinct but sometimes overlapping roles. ASIC, the Australian Securities and Investments Commission, is the primary corporate, markets, financial services, and consumer credit regulator. It has broad oversight of trading markets, market participants, disclosure requirements, and investigates misconduct like insider trading and market manipulation.
Okay, ASIC's the main corporate watchdog. Who else?
Then there's APRA, the Australian Prudential Regulation Authority. APRA is the prudential regulator, focused on the stability and soundness of deposit-taking institutions, banks, credit unions, insurance companies, and most superannuation funds. Its role is crucial for protecting depositors, policyholders, and fund members.
So APRA focuses on financial stability of key institutions.
Precisely. You also have AUSTRAC, the Australian Transaction Reports and Analysis Centre. It's the specialist regulator focused on combating money laundering, terrorism, financing, and other serious financial crimes. It oversees reporting obligations for financial institutions and other designated entities.
AML-CTF.
Got it. The RBA, the Reserve Bank of Australia, also plays a key role, particularly in overseeing the stability of the overall financial system, managing monetary policy, and regulating crucial clearing and settlement facilities that underpin market transactions. The ASX, the Australian Securities Exchange, while a commercial entity operating the main trading market, also has significant regulatory functions under its listing rules, governing the conduct of listed companies and market participants.
And they all coordinate.
Ideally, yes. There's the CFR, the Council of Financial Regulators. This isn't a regulator itself, but an overarching coordination body comprising the heads of ASIC, APRA, the RBA, and Treasury. Its role is to facilitate cooperation and coordination among the key regulators to promote financial stability and address systemic risks. So it's a complex ecosystem.
It certainly sounds like it. Okay, let's unpack the darker side. Market misconduct. Even with all these rules and regulators, misconduct can still happen and severely undermine trust. Let's start with market manipulation.
Right. Market manipulation is essentially conduct designed to create an artificial, false, or misleading appearance of active trading, market conditions, or the price for securities or financial products. The aim is usually to induce others to buy or sell, or to maintain a price at an artificial level.
The David Jones case mentioned, example 4.27, seems like an interesting example of the impact of potential manipulation.
Yes, that case illustrated the dilemma boards face. A rumor about a supposed takeover bid appeared on an obscure UK blog, causing a rapid surge in David Jones's share price. The ASX queried the company. The board was caught if they disclosed the rumor, they might give it undue credibility. If they didn't, and it turned out to be true or continued influencing the price, they could breach continuous disclosure rules. They ultimately had to disclose the rumor and state they weren't aware of its source. It shows how boards must react even to external attempts at manipulation to maintain an informed market.
So what are the underlying principles for prohibiting manipulation?
The core principles, as outlined in the guide, are about ensuring markets are fair, orderly, and transparent. They should allow for the efficient allocation of capital and fair distribution of benefits. If markets are perceived as being rigged or easily manipulated, trust evaporates, participation declines, liquidity dries up, and ultimately, the market can fail in its core economic function. Preventing manipulation is essential for maintaining that trust.
And directors or managers might be tempted to manipulate.
Unfortunately, yes. Directors, senior managers, or even major shareholders might have both the motive and the opportunity to manipulate their company's share price. For example, they might try to inflate the price before selling their own shares, or perhaps depress the price shortly before share options are due to be granted to them at a lower exercise price. The methods can range from spreading false rumors to engaging in artificial trades, wash trades, or matched orders, designed purely to create a misleading impression of activity or demand. And, as the guide notes, market manipulation is very often linked with insider trading.
That brings us to the John Hartman case, example 4.29. What does that teach us?
The Hartman case is a fascinating, albeit disturbing, real-world example involving both manipulation and insider trading by a young, highly paid equities dealer. He used confidential information about his employer's large upcoming trades, which he knew would likely move the market, to make personal trades ahead of those orders, a practice sometimes called front-running. This was both insider trading using non-public information and arguably market manipulation, profiting from the price impact of the subsequent large trades. His own reflections, cited in the guide about greed and the culture in parts of the financial industry, are quite sobering. It directly prompts question 4.9. Is there a connection between extremely high remuneration and a temptation towards market manipulation? It's a question worth pondering. Does immense financial pressure or expectation contribute to unethical behavior? And linked, but distinct for study purposes, is insider trading. While manipulation is about creating a false market appearance, insider trading is specifically about misusing confidential, price-sensitive information that isn't publicly available for personal gain or to avoid a loss by trading securities or by tipping off others to trade.
So using secret information.
Exactly. Information that, if it were public, would likely have a material effect on the share price. The Calvin Zhu case, example 4.28, is a stark example detailed in the guide. Zhu, an investment banker working on major takeover deals, systematically used confidential information about those upcoming deals to trade shares through intermediaries, including friends and family, netting over $1.3 million in illegal profits. His case illustrates the calculated nature of such offenses, the use of intermediaries to try and conceal the activity, and the severe criminal penalties, in his case jail time, that apply.
So thinking even more broadly now, what about bribery and corruption? How does that fit into the governance landscape? It feels like a universal threat to ethical conduct.
It absolutely is. Bribery and corruption are corrosive. They can have incredibly detrimental effects, not just on corporate and personal reputations, but can even damage the trading and business reputations of entire countries, deterring foreign investment and hindering economic development.
Most countries outlaw it now, right?
Yes, virtually all developed economies, and increasingly developing ones too, have criminalized bribery of both domestic and foreign officials, often attracting substantial penalties for corporations and individuals involved. One area that was historically a bit gray was facilitation payments.
What are those?
These are typically small payments made to low-level government officials simply to expedite or secure the performance of a routine, non-discretionary government action to which the payer is legally entitled anyway, like getting permits processed faster. For a long time, these were tolerated or even legally permissible exceptions in some countries' anti-bribery laws, including Australia's historically.
That's changing.
Yes. There's been a strong international trend towards prohibiting all forms of bribery, including facilitation payments. Landmark legislation like the UK Bribery Act 2010, which has extraterritorial reach, applies globally to companies with UK connections and makes no exception for facilitation payments. This stricter approach is becoming the international norm. Australia has also moved to tighten its laws in this area.
The guide mentions the Reserve Bank scandal and Shell Oil.
Yes, the case involving subsidiaries of the Reserve Bank of Australia highlighted alleged bribery related to securing international banknote contracts. And the Shell Oil example 4.30, involved a subsidiary entering into a deferred prosecution agreement, DPA, with the U.S. Department of Justice and paying substantial penalties over bribery allegations in Nigeria. These cases illustrate the serious legal and reputational risks, the increasing use of tools like DPAs, which often require implementing rigorous compliance regimes, and the growing focus of regulators globally on combating foreign bribery. There have also been Australian parliamentary inquiries into allegations of overseas bribery by Australian corporations showing the ongoing scrutiny.
Okay, now here's a more recent and really interesting development in the governance sphere. Critical infrastructure protection. This feels like governance extending into national security territory.
It absolutely is. Critical infrastructure refers to those physical facilities, supply chains, information technologies, communication networks, and essential services whose destruction, degradation, or unavailability would have a significant impact on a nation's social or economic well-being or its national security. Think power grids, water supplies, major ports, telecommunications networks, essential banking systems, food distribution chains, hospitals. The list is quite broad and vital.
And the focus is on resilience.
Exactly. Proactive risk management for these essential assets and systems is crucial for national resilience against threats ranging from natural disasters and accidents to cyber attacks and terrorism.
Australia recently updated its laws here.
Yes, the Security Legislation Amendment, Critical Infrastructure Protection Act 2022, often called the SLASI Pact, significantly expanded and strengthened the regulatory framework. It introduced several key measures effective from April 2022.
Such as
A new obligation for the responsible entities of critical infrastructure assets to create, maintain, and comply with a critical infrastructure risk management program. This requires them to systematically identify hazards, minimize risks, and mitigate the impact of incidents. It also established a new framework for enhanced cybersecurity obligations for a subset of assets designated as systems of national significance, potentially involving direct government assistance or intervention in response to serious cyber attacks.
So it imposes direct responsibilities on the owners and operators.
Yes, very much so. The overall aim is to make risk management, preparedness, prevention, and response planning just business as usual for organizations operating these vital assets. It also aims to improve information sharing and collaboration between industry and government on threats and vulnerabilities. Any entity, whether foreign or domestically owned, that owns or operates an asset falling under the expanded definition of critical infrastructure must now comply with these positive security obligations. It represents a fundamental shift, embedding national security considerations directly into corporate governance and operational responsibilities for these sectors. The guide encourages you to explore the list of critical infrastructure sectors covered by the Act. It's broader than you might think.
So shifting back towards the owners of the company, what does all this mean for empowering shareholders? It brings us back to shareholder rights and activism.
Right. We talked about some mechanisms like the two strikes rule earlier, but fundamentally, corporate law provides various safeguards for shareholder rights, particularly for minority shareholders, to protect them from being unfairly treated or oppressed by majority shareholders or management. The oppression remedy found in the Corporations Act is a key example, allowing shareholders to seek court intervention if the company's affairs are being conducted in a manner that is oppressive, unfairly prejudicial, or unfairly discriminatory.
What are the common basic rights shareholders have?
The study guide lists several common shareholder rights, often reflected in legislation and aligned with OECD principles of corporate governance, Table 4.7. These typically include the right to securely register ownership, the right to transfer shares freely, subject to rules, the right to obtain relevant and material information on the corporation on a timely basis, the right to participate and vote in general shareholder meetings, the right to elect and remove members of the board, and the right to share in the profits of the corporation, dividends. Underlying all this is the right not to be abused by controlling shareholders or management and to have their property interests protected.
And how do shareholders exercise these rights effectively, especially smaller ones?
That's where various forms of investor advocates and shareholder activism come into play. You have shareholder associations, like the Australian Shareholders Association, ASA, or the NZSA in New Zealand, which represent and advocate for the interests of individual retail investors. You also have influential proxy research and advisory firms like Institutional Shareholder Services, ISS, or Glass Lewis & Co. They provide research and voting recommendations to institutional investors on matters like director elections, remuneration reports, and mergers, thereby significantly influencing voting outcomes.
And the big institutional investors themselves.
Yes, large institutional investors, pension funds, insurance companies, sovereign wealth funds, investment managers are increasingly engaging in direct activism. They actively seek to influence corporate governance practices, board composition, executive personnel changes, corporate strategy, or capital management decisions at the companies they invest in, all with the aim of improving performance and maximizing the long-term value of their investments. While they act primarily in their own beneficiaries' best interests, their actions often benefit all shareholders by driving positive change and holding boards and management more accountable.
The guide uses the CalPERS example to illustrate this, particularly around the one share, one vote principle.
Yes. CalPERS, the huge California Public Employees Retirement System, has long been a vocal advocate for good corporate governance. They famously criticized News Corp's dual-class voting structure, where some shares carry significantly more voting rights than others, effectively entrenching control for the founding family despite their economic ownership stake. CalPERS argued, News Corp does not have one share, one vote. This is a corruption of the governance system. Power should reflect capital at risk. This highlights the strong preference among many institutional investors for the one share, one vote principle, believing it best aligns control with economic ownership and is fundamental to shareholder democracy and accountability. Dual-class structures remain controversial for this reason. Now, drawing several threads together, what becomes fascinatingly clear is the crucial link between a company's internal corporate culture, a robust code of ethics or conduct, and the effective prevention of misconduct. Good governance practices aren't just about rules and structures. They are fundamentally about embedding ethical values and behaviors throughout the organization. They serve to protect not only shareholders and financial markets, but also the board members and management themselves from legal and reputational risks.
The guide mentions HSBC's Supplier Code of Conduct as an example.
Yes, HSBC's Ethical and Environmental Code of Conduct for Suppliers is provided as an extensive example of how a broad code can cover not just internal conduct, but also extend governance expectations to external stakeholders, in this case, suppliers. It includes detailed requirements around labor standards, human rights, health and safety, environmental protection, and business integrity within their supply chain. This demonstrates a comprehensive approach, trying to embed ethical conduct beyond the company's own walls.
And conversely, the Olympus Corporation case study, sample 4.33, shows what happens when governance and culture fail spectacularly.
It's a truly dramatic and sobering example. The Olympus scandal involved a massive, long-running accounting fraud, concealing huge investment losses for decades through complex schemes. When it finally unraveled, it caused immense damage to the company's reputation, destroyed shareholder value, led to arrests, and shook confidence in Japanese corporate governance.
What was the fundamental cause identified?
A fundamental cause, as pinpointed in your study guide and widely discussed afterwards, was the striking absence of genuinely independent directors on the Olympus board. This lack of independent oversight was, at the time, quite common within the traditional Japanese corporate governance system. Keiretsu structures often involved cross-shareholdings and interlocking directorships. There was also clearly a deep-seated cultural reluctance within Olympus to challenge authority, lessen the power of entrenched, non-independent board members and long-serving management, or allow dissenting voices. This toxic combination of weak governing structures and a compliant culture allowed the fraud to persist for years. The scandal led to serious soul-searching in Japan about whose interests a company should primarily serve just shareholders, or a wider set of stakeholders including employees and society, and prompted significant governance reforms. It starkly underscores how corporate culture, a lack of independent oversight, and resistance to transparency can lead to catastrophic governance failures and a complete erosion of public trust.
This really brings us full circle, back to something we touched on earlier, but which the guide revisits as crucial, the importance of whistleblower protection. Given the Olympus case, where internal dissent was clearly suppressed, you can see why it's so vital.
Absolutely. The importance of effective whistleblower mechanisms and protections cannot be stressed enough. As we discussed, it's evolved significantly over time. Historically focused mainly on protecting government interests from fraud, the concept has grown to encompass disclosures about occupational health and safety, environmental damage, financial misconduct, and a wide range of unethical or illegal corporate activities. And the modern legislative approach, like that seen in Australia's Corporations Act Part 9.4 AAA, reflects this evolution. By providing clear legal protections against retaliation, allowing for anonymous disclosures in many cases, mandating that companies have proper internal policies to handle disclosures, and imposing significant penalties for victimizing whistleblowers, these laws represent a really valuable, tangible addition to the corporate governance framework. They directly recognize that empowering and protecting internal disclosures is often the first, and sometimes the only, effective way to uncover serious wrongdoing before it causes irreparable harm. It's an essential component for fostering integrity and maintaining market trust in the modern corporate world.
Okay, that was a really comprehensive journey through Module 4. Let's try to unpack this now. What are the big, actionable takeaways from our deep dive into governance and practice? What should listeners really focus on?
We certainly have covered a lot of ground today, and you're right, distilling it down is important. I think there are 5 key insights or takeaways that really stand out for your understanding and, crucially, for tackling exam questions relating to this module.
Okay, number 1.
First, the holistic nature of governance. You really need to grasp that good governance isn't just one thing. It's not a single checklist item you can tick off. It truly demands a blend, a synergy of effective board dynamics, and that means proper director appointment processes, genuine accountability mechanisms, and embracing diversity of thought and background, coupled with a strong, embedded ethical culture, robust risk management frameworks covering all types of risks, and an organizational commitment to continuous improvement. All these elements absolutely must work together in concert.
Right, it's an ecosystem. What's number 2?
Second, accountability and transparency are non-negotiable. The mechanisms we discussed, things like the two strikes rule, giving shareholders a real voice on pay, the stringent criteria for director disqualification, holding individuals responsible for failures, and the detailed executive remuneration disclosure requirements. These aren't just bureaucratic hurdles. They are absolutely critical tools for holding corporate leadership accountable for their decisions and performance. They empower shareholders, regulators, and the public to ensure corporate behavior genuinely aligns with legal requirements and stakeholder expectations.
Okay, holistic governance, accountability. Number 3.
Third, the constant interplay of legal and ethical considerations. Corporations operate within an incredibly complex and constantly evolving web of both civil and criminal laws. This includes specific areas like competition regulations, comprehensive consumer protection laws, environmental laws, workplace laws, and overlying all of this are fundamental ethical obligations. You need to appreciate that there are significant personal consequences for directors and officers, as well as massive corporate consequences for noncompliance. These range from huge financial penalties and damages awards to reputational ruin, loss of operating licenses, and even in some cases, imprisonment for individuals. Navigating this intersection is core to governance.
Makes sense. Number 4.
Fourth, remember that effective governance protects all key stakeholders. While shareholder value is often a primary focus, truly effective governance extends its protective umbrella much wider. It's fundamentally about safeguarding the legitimate interests of a broad range of stakeholders. Crucially, this includes employees through fair work practices, robust occupational health and safety systems, and vital whistleblower protections. It also clearly includes protecting consumers through stringent laws against misleading conduct and unconscionable behavior, and increasingly critical through rigorous data privacy regulations and cybersecurity measures. Good governance recognizes this broader responsibility.
Great point. And the final takeaway.
And finally, number 5. Governance involves continuous evolution and maintaining market integrity. The governance and regulatory landscape is not static, it's incredibly dynamic, it constantly evolves, often reacting to past failures like Enron or the GFC, and adapting to address new and emerging risks, like cybersecurity threats to critical infrastructure or sophisticated forms of financial market manipulation. The overarching goal of these ongoing reforms and regulatory efforts is always to bolster trust, foster innovation within ethical boundaries, and maintain the integrity and value proposition of the financial markets for the benefit of all participants, investors, companies, and the economy as a whole. Understanding this dynamic nature is key.
That's a fantastic summary. And mastering this content, as we've said, isn't just about ticking boxes for exam success. It's really about becoming well-informed, ethically aware professionals. These are the principles and practicalities that will genuinely guide your decisions and fundamentally shape the organizations you work with or advise throughout your entire career. And that, believe it or not, brings us to the end of another really in-depth, deep dive. We genuinely hope this exploration has given you a much clearer, more practical understanding of governance and practice, Module 4, and importantly, armed you with valuable insights and context for your upcoming exam.
We're certainly rooting for you on your exam journey. Please remember, getting to grips with these concepts deeply, understanding the why behind the rules will serve you incredibly well, far beyond just passing the test itself. And maybe a final thought to leave you with. Consider how these governance principles we've discussed, board independence, risk management, stakeholder protection, ethical culture, apply not just to huge public companies, but also perhaps to a nonprofit organization you volunteer for, or even a small family business or startup. Why might robust governance be just as important, perhaps even more critical in some ways, in those contexts too? Something to ponder.
That's a great point. Now, don't miss our next deep dive where we'll tackle the next essential chapter for your exam success. Make sure you subscribe now so you don't miss out. And if you found today's session helpful, please do share it with your study group or colleagues, or perhaps leave us a review. It really does help us reach more candidates who are ready to ace their exams.
Until next time, keep studying smart, stay focused, and we'll see you in the next deep dive.